Salutations everyone. Welcome to another edition of the Power Options Radioactive Trading Open Discussion and Open Forum. For today, of course, is Friday, February 18th. It is an expiration day, so I'm sure a lot of you have questions possibly about rolling positions, editing positions, and so forth, and we will get to those. We're also going to do a quick 10-minute presentation discussing some of my thoughts on rolling positions as well. A couple examples that came up during conversations today, Power Options customers calling in with some of their trades as well. And I'll just share with everyone my general basic advice when looking at rolling positions, whether they're working for you, working against you, or now completely out of bounds. So we're going to cover a lot of information today. And of course, remember, this presentation is designed to handle your questions. So after that brief 5 or 10 minutes small presentation, we're going to discuss rolling and using the Power Options tools to evaluate that. We'll handle all of your questions. All right, well, let's go ahead and get started. My name is Michael Chupka. I'm the Director of Education here at Power Options. I'll be your presenter for this afternoon. I've had the great pleasure of working with Power Options for the past 8 years. I handle a lot of the coaching sessions and the various education on the site. I have co-authored 2 books on investing with Ernie Zerenner, the president and founder of Power Options. And Power Options is, of course, a patented suite of search and analysis tools designed for self-directed options investors. And we support over 23 different option strategies. I am versed in all strategies on the site and, of course, strategies that aren't on the site to answer any questions that you might have about those. But there are certain strategies I won't trade in my personal accounts that they just don't match my personal risk-reward tolerance, things such as iron butterflies, short straddles, and short strangles, for example, and naked calls as well. Now, the processes and procedures for today's presentation: simply use the question pod to pose a question that you have about options trading, power options, radioactive trading, even power option supply, general market questions. Please feel free to ask as many questions as you want. Now, we may not have time to answer all the questions, but if we have an overflow of questions, we'll just stay on the line longer and make sure we handle all the questions as best as possible while still respecting your time. If I have to stay online until 6 p.m. to answer some of the questions that came in, I'll be more than happy to do that. Now, of course, as I mentioned, the questions be about tools and power options, radioactive trading techniques, the Power Options Applied Advisory Newsletter Service, or just general options strategy and general education, strategy questions, rolling questions, anything that you have, feel free to ask. We have some basic ground rules. We never had a problem with any of these before, but we just like to mention them all the time. We just ask that you have respect for all attendees and presenters. Consistent negative behavior will not be tolerated. Please be patient. As I mentioned, there might be several questions ahead of yours, but we will get through all of the questions. And I encourage you to feel free to help us help others. If I'm answering a question or I'm presenting something in your market experience, or you have a different concept of how you like to approach that situation, use the question pod to send that over to me, and I'll of course share that with the rest of the audience as well. Most important, for traders and investors, we're looking forward to a 3-day weekend. It is the weekend, it's expiration. Probably used a lot of brain power today trying to figure out whether we wanted to adjust our positions or manage our positions. So let's relax, let's have some fun, let's get some good education, and enjoy the 3-day weekend going ahead, and look forward to trading next Tuesday. Now, as I mentioned, for today's discussion, I'm going to spend about 10 minutes from this moment. We'll take a discussion on rolling. We're going to focus on covered calls, but it will apply to other strategies as well. This discussion is going to focus on common problems investors might face on expiration. Then we're going to do our brief search to see if there are any new weekly options that have been released, and then we'll handle your questions. All right, let's navigate over to the main Power Options suite of tools here. And I'm going to go directly into my portfolio, and I'm going to go into the profit and loss portfolios there. And let's take a look at some open positions that we have. Now, this is my covered calls portfolio that we have as a paper trading portfolio. I do have one collar mixed in with the menu. And we want to take a look at a couple of the positions that are open and how one might look forward to rolling them. Now, the first position we want to start off with is sort of down here near the bottom of our covered calls, the LDK Solar position. There are actually 2 of them that are in here. One was entered during a webinar on January 12th, and one was entered on January 24th. The first position that was entered on the 24th, LDK was purchased as a paper trade, of course, at $14.44. The February 15 call was sold for 70 cents. Now, as I use the PowerOptions portfolio tool, I always have checked the box up here in our settings menu to view the position analysis. And what that will do for me is add 6 extra columns over on the right-hand side. So on this first position, what I see with my analysis is that my original expected profit and loss for the LDK position that was opened in February was $126 off of a $1,374 investment, or 9.2% return. Now, the stock is currently trading at $14.45, and remember, we sold the February 15 call. So it stayed out of the money. It didn't go above our strike price, so we're not going to realize the maximum return. We are at expiration, so we could liquidate right now for a 5.1% gain, or if we hold it to expiration, or we didn't close it today, we let it expire, we'll have a 5.2% return, just that extra 1% of time value that we wouldn't have to buy to close the option for, because it'll still expire worthless. And I wanted to bring this one up, of course, because that's most likely what I would have done. Just allow this position to expire. The natural bid price is still listed at, or the natural ask price, excuse me, to buy to close the call would be 1 cent. Might as well just let it expire worthless, not pay any commissions. Now, the only downdraft of that, of course, the only downfall of that, I should say, is that, well, we didn't roll the position yet, so we have to wait to Tuesday now to look for a new position. But of course, using the PowerOptions tools, what I would have evaluated for the first LDK position, let me just go ahead here, and we'll go to the position analysis screen from the More Information menu. This will give us a breakdown of our current position. Okay, now, in this scenario, we see the profit and loss chart over here on the right. We see our existing position. Of course, we held it all the way to expiration, so we only have 1 day left technically because they do expire on the following Saturday. Time value is only at 0.1%. And we scroll down further and we see the basic information that we saw before on the portfolio page when I select that View Position Analysis link. My current liquidation value is 5.1%, and at expiration, if I let it expire, it would be 5.2%. We save the 1 cent there in the commission cost by not buying to close the option. So we essentially made 98.6% of what we could expect to make at expiration. Now, that's not saying that we're making 98.6% of this 9.2 we originally expected. That only occurred if we were above $15 per share. So right now with this call expiring, we're making 98.6% of what we'll make tomorrow essentially by just letting it expire. And then of course as we scroll down further, we'll see the potential rollout opportunities for our position. If we sold the March 12 call now, or the March 13 call, or the March 14 call, and so forth, what would our new adjusted net credit be, our new downside protection for the covered call, and our new percent return if assigned. Now, what am I evaluating right away when I look at these positions? Whenever you open any position, you should always have in mind what are your goals for the positions and what are your expectations. Naturally, with this position, when we entered it during the webinar on 124, my expectation was, okay, well, let's assume that we think the stock's going to be trading above 15. We're looking to get assigned for the full maximum profit. Of course, if the stock falls, we didn't have anything protecting it down at the bottom, so we were taking a lot of risk there down on the downside. But when I go into a position, I have planned out what my goals are. Typically, if I'm doing a standard collar or a naked put trade, most of you know I very rarely do, in fact I never do a straight covered call anymore. I usually just do a standard collar spread. But I'm just using this as an example with a covered call because it's the most commonly used options trading strategy. But in this scenario, when I open the position, let's say that my goals originally were to make 2.5% to 3% per month. That's what I'm looking to accomplish realistically with my covered calls trade. Now this one worked out the way I wanted to. I'm making about 5.1% after 25 days. Right now, just by the liquidation, the gain in the stock, and the premium we received for the call. We were looking potentially originally for that 9% gain if it was above 15, but right now we have a 5% gain. But what I'm looking at when I first evaluate these rollout opportunities that are shown is I want to look at my potential percent if assigned. Now in this case, since the stock's trading right at the strike price, or just a little bit below, the 15 strikes about 50 cents out of the money, what I'm focusing on here is already met for me. And what I mean by that is that if my goal with doing any covered call position was to make 2.5% to 3% of my portfolio, we're roughly making 5% now at expiration. So what I have to make sure is that my new percent if assigned is at least 2.5% to 3% higher than what I have right now. Otherwise, it's not a reasonable trade for me, is it? For example, if this March 12 call, if I rolled to the March 12 call today or the day before, and it only had, let's say, a 5.7 or 5.8 potential return if assigned, that wouldn't make sense for my goals. It's only 0.6% more than what I'm making right now. Okay, so that's kind of what the first thing you want to look for is, does the new position that you're rolling to match your goals? And at the same time, does it have a reasonable expectation of profit? Our original expectation was the stock would be trading above 15 on February expiration. It didn't reach that. It's trading at 14.45. Maybe the stock's not as strong as we thought it was. When we look at these higher strikes, again, the March 15 call, we could go up to maybe a 15.3% return if assigned if the stock's trading above $15 at March expiration, but there's only a 41.4% chance of that occurring. And also, if we go to the 16 call, which is further out of the money, we might make a 20.2% return, but the probability of that happening is very slim. So you want to make sure that the position that you're rolling to, don't roll for the sake of rolling. Make sure the position still matches your goals. Now in this scenario, it was a little bit easier to follow. Our call is going to expire worthless. The stock is currently trading well above our cost basis because we collected $1.35 when we sold the March 15 call. So right now, if we were rolling this as a covered call, we're still in a good scenario. We could even drop the strike price down to the 14 strike and still get another 6% potential return if assigned if the stock stays above 14 from the 5.1% we're making right now. So that this is a pretty good position to be in when rolling. Okay, you just have to decide which strike price would you like to roll to that has the better probability of getting assigned next month, and what return are you looking to achieve to still match your goals. Now let's close this window and look at a second position. Another position that we have here, Fossil, F-O-S-L, this was opened earlier. This was already rolled one time before, and the cost basis we dropped down to $68.50. The original paper trade was open on December 12th. And we eventually rolled the call at expiration, on January expiration on 119. We rolled to the 70 strike call, which we sold for $3.60. In our previous return, we bought the stock originally at 71, but our previous profit lowered our cost basis down to $68.50. But we obviously didn't pay attention to this position during the expiration time frame. The stock's now at $79, and it's going to cost us $9.10 to buy back the call, if that's in fact what we wanted to do. Well, what are our expectations now? We had a choice. Do we let this get assigned today, or do we roll it to a further out month and maybe a higher strike price? Well, this is the tricky part, and we're going to look at one more example after this, but when we let the stock go too far above our call strike price, and then we look to evaluate it and say, okay, do I want to roll the position now? Sometimes, to me personally, it doesn't make sense to roll it in some of these situations, okay? You might actually just want to let it get assigned, and then when you run your search on PowerOptions to look for new positions the Monday following expiration, if Fossil comes up and you still feel strong, maybe you want to get back into the position. But we'd evaluate our rollout opportunity. So again, we'd go to the position analysis screen, see where our profit and loss chart is for this covered call position, which is based on our effective cost per share, $68.50, and the 70 call that we sold for $3.60. We have our original position value, our current liquidation value, and our future expiration value. So right now, we'd make 7.5% on the position that we've been rolling since 12/2. Okay, so that still kind of matches my goals right now. We've been in it for about 3 months, and we've just about averaged a little bit over, we've averaged just about 2.5% per month on this position. And if we let it get assigned, we'll make 7.9%. There's still some buyback, some extra intrinsic value thrown in there. That describes the difference right now between the 7.5% and the 7.9% in one day. All right, now let's scroll down below and we'll see some of the rollout opportunities. Now this is a really good example of what I was referring to. We're February expiration. If I made no adjustment, if I looked at this trade this morning, I would have seen that I could have liquidated for maybe 7.5% if I closed it out right now, or just let it get assigned for 7.9%. That did match my goals, as we mentioned. It's at least 2.5% over the past 3 months. I'm still within my range of making that 2.5% to 3% per month. Now I see that I could buy to close my call for 9.10 right now, and I could sell to open a March 75 call for 5.30. Now if I've increased the strike from 70 to 75, so if the stock stays above 75 at March expiration, and there's a 70.2% chance of that happening, well, my new percentage return would be 9.2%. Does that match my goals? No, it doesn't. Right now, if I let it get assigned, I'm at 7.9%. If I roll to the March 75 call, buy to close my current call for 9.10, sell to open my new call for 5.30, 29 days from now, if the stock's above 75, I'll make 9.2%, but that's only a 1.3% increase from where I am right now. That doesn't match my personal goals. This might not be a rollout opportunity that I would consider because I have to keep in mind what are my personal goals. I don't want to roll for the sake of rolling. I want to roll just if it matches my expectations and if it matches my goals. Now, what about the 80 call? Oh, okay, well the 80 call, we're going to collect a smaller premium, so we are going to have to pay a debit to enter the position. We're going to take essentially $3 out of pocket. Remember, we received $3.60 when we sold the February 70 call, and we'd have to buy it back now for $9.10. Then we'll collect another $2.50, so that will still give us a $3 debit out-of-pocket premium in order to potentially get assigned at a 10-point higher call, to get assigned at 80 instead of at 70 right now. So this would increase our potential percent if assigned to 11.9%. Okay, 29 days from now I increased my potential return by 4%. That matches my goals. I might consider doing this. But my probability, since Fossil has just recently gone up to this $80 level and is trading up around $80, excuse me, is only about 44% that it might stay above 80 on March expiration. So you have to take everything into account. Am I more comfortable letting it get assigned right now for 7.9% as opposed to rolling to the 75 call, which did not match my goals, or rolling to the 80 call, which might not match my goals for the expectation of getting assigned and earning this new return? Don't always roll for the sake of rolling. Analyze what's best for you and what matches your goals. One other quick review. Oh, and of course, I just wanted to mention, in order to compare this side by side, in addition to what I see here, it's great to see things numerically, but as many of you know, my next step, of course, from the rollout opportunities, I'd go to the Simulate Trade feature here for the March 80 call, and this would just allow us to view a side-by-side comparison of where my current position stands. Max return 7.9%, which would occur on Saturday because we'd get assigned at $70 with a stock at $78.89. But if we roll to the 80 call, we'd have that new potential profit of 11.9% or $850. We see that in the graph. But the stock has to be above 80 in order for us to realize that return. Does this match your goals? Well, yes, it does. We saw that on the other page. It is giving me that extra 2.5% or 3% for the next 29 days. But does it match my expectation? Am I comfortable with the expectation that Fossil may go up above 80 in the next 29 days and stay there? And if I'm concerned if the stock's going to pull back, maybe it'd be better just to let this get assigned today and then look for a new position on Tuesday. All right. The last scenario, okay, so it was longer than 10 minutes, I apologize. The last scenario is, this was actually from a customer's call today, this afternoon. Stock got away from him due to an earnings event today. Now what I want to focus on here is Aruba Networks. I put in, this wasn't the customer's position, I put this in as a historical trade after I looked it up before the webinar. But let's say on February 1st, Aruba Networks, ARUN, was trading at 22.15. Now at the time, I might have just decided to take a chance, 50-50 probability, sold the just out of the money call, the 23 call, for $1.35. That looks like a pretty rich premium, and in fact it was. And there's a reason why, and you can kind of see that from the other lines there, but we'll go over that in just a minute. Let's scroll over now to look at the original position setup here numerically. Well, this particular covered call, our total cost into the position would have been $20.80. We are looking to make a profit of $220, which is a 10.6% return if assigned. Right now, we did use the March option, so it's still 30 days away. But this is important because this is what the customer was asking, and we wanted to evaluate this. Right now, the liquidation value is 9.6%. It's just about 90% of what we expected to make on the position. And if we hold it all the way to March expiration for another 29 days, we'd realize the 10.6% return. This is assuming that the stock is at the same price it is right now. I'm not speculating it's going to move any higher, for example, or lower. It's just if the stock stays where it is. Well, where is the stock right now? Remember, it's bought at $22.15 on February 1st. The March 23 call was sold for $1.35, and the current stock price is $31.19. Well, why would you let a stock get away from you this much, as we kind of did with the fossil position, which was a paper trade we were just ignoring? And it's not so much that you let it get away from you, it's that the change today, due to earnings, the stock spiked up $4.51. So it had almost a 12 to 15% jump today due to the earnings. And of course, the option was trading at $4.02 at close of business yesterday, and this morning jumped up to $8.40. Well, it was trading around $4.20, and it jumped up to over $4 today. So it's trading at $8.40 right now. Now here's the scenario. Do we roll this position now for a higher profit? Do we hold it further to March expiration? He wasn't assigned early, of course. The customer was not assigned early. I should mention that. Well, let's evaluate again using the position analysis screen. And there's also a functionality that comes up in this scenario that we talked about in another webinar, a previous webinar that I'll show you. Okay, so our scenario, we had the stock $22.15, sold the March 23 call for $1.35. Stock's currently at $31.22. Since the option is so deep in the money, we only have 0.6% of time value remaining, even though we still have 29 days left to expiration. All right, and we scroll down, we see our further details again. Our original expected return is 10.6%. We could liquidate the entire position right now for a 9.7% gain, which is 91.8% really of what we expected to make at March expiration. 80-20 rule is commonly used in these scenarios. If I've already made 80% of what I expected to make, and this applies for credit spreads and other positions, might as well liquidate the position, take the 80% of what I expected to make, and then move on to another position. All right, but let's look at our rollout opportunities. We have some Aprils listed, but where's our trick? See, there's not a lot we're gaining here because the stock got away from us. If we hold to March expiration, we'll make 10.6%. If the stock's still trading above $23 per share, it's now at 31. If we bought to close this call, our 23 call, and rolled just to the 25 call, for the next 60 days, we're gaining absolutely nothing. This is essentially true of the April 26 call as well. We're really not gaining too much more. This is the reason why they're equal is because it's based on the new cost basis we'd have on the position and the new strike. Essentially here, since the 25 and 26 strike are also deep in the money, we're not really changing anything. Why would I roll to the 25 or the 26 call, which has 57 days out in time, if that's still equal to my current percent return? It doesn't make any sense. Why leave money tied up for no gain? Okay, so we got to go to a higher strike price naturally. That's what we'd be looking to do. Well, now with the stock's trading at 31, what happens if we roll to the 29? Okay, so an extra 30 days. Remember, we still have 29 days to expiration. So about an extra 28 days after that, we could move from 10.6 up to 13.3%. Okay, that matches our goals. Remember, 2.5 to 3%, we're gaining an extra 2.7%, so this might match. Or, of course, we could go to the April 30 call, which would give us a 14.5% gain. But remember, because we let this go so far against us, and it's going to cost us $8.40 to buy to close our call, we're going to be rolling to this month for a debit. You may ask, why aren't other scenarios showing? There's got to be other options that are available to roll further out in time to roll for a credit. Well, that's right, they would, but they're not showing here because they're not really increasing the percentage return by much. As you roll further out in time, you'll be able to roll for a credit, but your annualized return is not really increased over what you have right now. You're not really gaining anything long term if we roll to the June or July. So that's why those options aren't shown. But let's go ahead and link here to the option chain from one of our selections. And the quick reason why I want to do that is because I want to show something here. We have the March call. We're at February expiration. We have the March call. We could roll to April's. Oh, and I was wrong. I did that for a reason. I made myself look stupid for a specific reason. The Aprils are only shown because that's only the next cycle that's available. There's nothing available yet that's further out in time due to the cycle for this particular stock. So, oh wait, maybe there is. No, there we go, all months. Sorry about that. There are some leap options, I'm pretty sure. There we go. I apologize. There's our July options. That's what I was looking for. So here, we could roll out to July, but now we're going 148 days out in time. Okay, so we're going almost 5 months out in time to try to roll for a credit. And the premium here is $245, or it's $450 for the 30, for example. It's a tricky scenario. What's usually best in these situations, your option, remember, is not expiring today. It's gotten away from you because earnings came out and the stock jumped 12–15%. We're now deep in the money. There are some rolls we could do from March to April, but a better thing to do in these scenarios, since you weren't assigned early, you are still risking being assigned at this price, but we should all be lucky to get assigned right now early, an extra 30 days ahead of time for a 10.6% gain. I would love to have that happen every time. But what we're really focusing on here is the fact that right now we have logically only the April series available unless we try to roll 5 months out, and then we're leaving our premium sitting there for 5 months or 4 months before the time value decays to make logical sense to roll again with the July series. And we're lowering our annualized return, of course, each time we do that. So what we're kind of looking for now is, if I haven't been assigned early here and I'm holding this position, this reverts back to the other webinar I was talking about, the waiting to roll, because now it might be better to wait until Tuesday to look for other potential rollout opportunities on this March call. Still 29 days to go, but it's so deep in the money now. And the reason why, on Tuesday morning, following our February expiration, a new series will come up. Well, probably we might see the May options become available on this stock, or there might be some June options available. A new series will come out once we hit February expiration. So that will be a good opportunity to look to see what other opportunities might exist. Don't feel forced to roll, wait to roll. Now the real solution to this problem we're looking at ARUN. Remember, the stock jumped up $4.50 today. The option has been so deep in the money now, we still have 29 days to go. Realistically, to me, you probably already grasped this. If I was in this scenario, I might just liquidate today and take that 9.7% profit, which is 91.8% of what I expect to make in the next 29 days if the stock's still trading above 23. That's the 80-20 rule. We talk about that in some of the educational articles for covered calls. But what we really want to, where was I going? Ah, sorry, I just lost my train of thought. I apologize, ladies and gentlemen. So we might liquidate now, I'm sorry. But the real way to avoid this scenario is you want to just focus, you always want to keep focus on your stocks. And in this scenario, even if my option, the stock moved up $4.50 today, so it would have been trading at around $26.50. Even though I sold the 23 call for $1.35 when the stock was at 22, if the stock was at $26.50 yesterday, before earnings came out, I'd still be tempted to buy to close this option. Probably would have been around $4 at the time, just to leave the upside open perhaps. Or I might have even liquidated the covered call at that point if it was still near my profit. Because if you're looking at it now, you're saying, oh, I wish I would have rolled, or what do I do now to take more of the upside? With this kind of movement in a stock, you've already missed it. you've really already missed it. Yeah, we can still hold this position for another 29 days. Risk getting early assigned. That's okay because we'll still make the 10.6% if it stays above 23. But because of the earnings event and because of that large spike in earnings, when you had the covered call there, you missed it. It's going to cost you that $4.50 more to buy to close the call now. So it's a trade-off. Now, one of the recent alerts that we added into the portfolio, if you click on the view there and you go to alerts, is that you can select to be notified if you're within 2 days or 3 days before an expiration or next dividend date. For those of you doing covered calls, naked puts, or credit spreads, I would suggest you start using these two new features here in the alerts column, because a lot of times it just gets away from you. Forget maybe when your earnings are coming up on your stock. I know that sounds silly. I mean, I know that sounds, hey, I've got my 8 stocks in my portfolio. I know exactly what's coming up. I'm tracking them for a reason. But this happens to a lot of investors. I see it happen all the time. It's just, oh, the earnings came out. I thought they were at the close. They were actually at the open of that day. And when it opened, it gapped up 5 points, and I missed my window. I thought they were at close the next day, and so forth. You really want to know when they are. You really got to pay attention to that so you know maybe you want to close a call, or maybe you want to adjust the spread before the earnings come out so you don't get caught in a position that ends up getting away from you. Now, this is a good way for the position to get away from you. I can't tell you how many spread traders I've talked to over the years who accidentally forgot about earnings coming up. They had a bear call spread and the trade was going well for them. The earnings came out and the stock spiked. Well, and then they entered a full loss into the position after a one-day move. So now you're just holding for the next 5-10 days to expiration, hoping it comes back down below it, but you've essentially already hit the maximum risk. So just start using those alerts there in the portfolio and keep track of when your earnings dates are coming up, and keep in mind what you may want to adjust or may not want to adjust in the position before going into that level. Okay, well, I hope that was useful for everyone. I hope that we covered some things there that may have come up to you before, or you had curiosity of how to use the PowerOptions tools when evaluating if you want to roll or if you want to hold the position, or things of that nature. I just wanted to present that because I think I had 7 or 8 different phone calls today alone just on what should I do now, when should I roll my positions, how can I use the tools to help me rolling the positions. So I wanted to give a brief review on that because it is an expiration day, so we might as well approach it when the questions are being asked. All right, I'm going to go ahead and queue up our search for the weekly options, see if any new series have come up. But again, I know I took longer than 10 minutes. I knew I shouldn't have put a time limit on myself for that discussion. But we still have plenty of time left, so go ahead and start sending me your questions using the question pod. Any questions you have about the PowerOptions tools, the options trading, options strategies, and we'll go ahead and address those. All right? Okay, so what I'm doing now while you guys are plugging in your questions and sending them to me, I'm going to go into the Naked Put search tool, and I'm going to scroll down to the bottom. This is how we typically start our open discussion every week. And as I scroll down to the bottom, I'm going to hit Clear These Settings. Now, what I'm looking for today is that our new weekly series should have been released yesterday on Thursday, those that expire next Friday. At last count, what we were looking at was 40 securities that offered weekly options. I believe it was 24 stocks and 16 indexes and ETFs. So we cleared out our settings from the base search. I'm going to select my option expiration time frame of all months. I could select March if I wanted to, but I'm just going to select all months. I'm going to narrow my days to expiration from, in this case, I'm just going to go 2 to 9. So I'm filtering out everything that expires on Saturday and including any of the options that will expire next week. So I don't see duplicates of various strike prices. I'm going to go into my Show Out of the Money field, and from the number of strikes out of the money, I'm just going to plug in 1 to 1. So we'll only see the out of the money strike for any put options available on securities that offer weekly options. And we are going to use no other criteria. And let's submit that setting and see where we are. All right. Ooh. Now, I don't know if I can figure them out at the top of my app. There's one. We have 50 now. Hey, so the first time in about 4 weeks, it looks like we've increased our number of securities in the weekly options, or securities that have weekly options, by 10. All right, I see at least one of them in this list so far, but let's take a better view. Ooh, I think I see two, actually. Okay. Remember what we always do in this situation. Let's scroll down to the bottom. And what I want to do now is, remember, using the recommended list section in any of the searches, we can select to see if we just want to view the indexes, ETFs, and holders. So that would show us only the indexes and ETFs that offer the weekly options. Or we can remove indexes, ETFs, and holders, and that will only show us the stocks, the common stocks that offer weekly options. So I'm going to do that, and let me hit submit. I believe the count was 24 last week of stocks. It's now up to 31. So there's 7 new stocks that offer weekly options. Now I'm not positive, but I thought Priceline was in there last week. I think Freeport McMoRan is new. I don't think that was there last week or 2 weeks ago when we ran this. I'm also pretty sure that Caterpillar is new. I don't think that was in our previous list. I don't know if Goldman Sachs, I think, but was Research in Motion. That might be one of the other ones. All right. Well, we're going to do a back test on this as well, so we'll just write them down there. Okay, so I'm saying I think for the stocks, I'm pretty sure there are 7 new stocks that are here, and I believe it's PCLN, FCX, Caterpillar, and RIM. Okay. JP Morgan. I could have sworn I've seen them. Let me go to page 2. Let's see what we have in page 2. So anything sticks out to me as new. BP, Qualcomm, definitely. Verizon, there they are. These two I don't think were there last week. Qualcomm, Verizon. I know Massey Energy was. I know IBM was. I don't think Exxon was. I'm not sure. XOM. Okay. Pretty sure Cisco was there, and Yahoo. That might be a new one too, so I'll put that one in as well. But that, I think I'm above 7 now. 1, 2, 3, 4, 5, 6, 7, 8. Okay, I put in 8. So maybe Priceline was in there. Maybe XOM was in there too. All right. So let's see here. Is there an easy way to do it? No, I can't do that in an easy fashion. That's okay. What I'm going to do, with your permission, of course, so I don't see any questions coming in. And please, if you have any questions, send them in, and I'll stop what I'm doing here on these weekly options. This is kind of for fun, but also just to kind of give you guys a broad idea of what new securities are available. All right, so what we're going to do now, I'm actually going to save this search. Okay, let's go ahead and click Save. Just this base criteria, and I'll call it Weekly Stocks for now. And this is in my naked put screen. Just the one strike out of the money. Okay, and I'll click Save this search. Now it's not going to change anything. It's going to run the same search there, but we have our listing available. Now what I'm going to do, let's keep this, do I want to do it that way? Yeah, I do. Okay. Let's see here. Sorry, let's go into naked put, and let's go into back test. And I'm going to go into the Smart History Excel menu, and we're going to stay in naked put. I'm going to select February, and I'm going to run a search on February 7th, which was the Monday, the first Monday. Tuesday was February 1st, so February 7th was the first Monday. And we're going to run our search on that date to see which securities had weekly options. Now my list might be a little bit truncated, but that's okay. All right, so Cisco was there. Priceline was there. Okay, Priceline was, and so was RIM. I was wrong on 2 of the 3. Priceline and RIM already had weekly options available. Okay, doesn't look like FCX had weekly options available. So let me do something here. There are 24 results, so I need to see the other page. So let me restrict the naked yields to be less than 0.6%. Okay, and the reason why I'm doing that is because you see the yields here, sorting it by percentage yield, and the max yield ends at 0.6%. So I'm going to see the other 8 that have a naked yield less than 0.6. Okay. All right, so Goldman Sachs was there. Right, so I still have FCX, CAT, Qualcomm, Verizon, ExxonMobil we didn't see in our list, nor Yahoo. 1, 2, 3, 4, 5, 6. I think I'm still missing one. So there are 24 here, and we had 31. And the ETN was still included, so that one was still available. All right, which one did I miss? Yeah, there's VXX, JP Morgan. We saw Goldman Sachs. I missed an obvious one. All right, let's go back to our main search. See if we can pick that one out again. AIG we saw. Netflix we saw. Google was there. Was it Intel? Yep. Okay. Ford was there. BAC, Massey Energy, IBM. Okay. So I think, yeah, but these ones, Verizon, Yahoo, we do have some new ones there. Probably going to have to write an article about that coming up. All right, now, but there was a total of 10, and we're seeing only 7 different ones added to the long stocks. So that means that there was also some ones added into the indexes and ETFs. So let's scroll down to the bottom. From our remove list section, let's go ahead and select no lists, and then I'll select the indexes and ETFs from our lists. And this should pull up our remaining 19 securities here. Okay, I'm pretty sure I think I see them. So the other remaining ones that are new, I'm pretty sure UNG might be new. We had the indexes of OEX, SPX, XEO, TJX was already there, FAZ we knew, SPY of course, XLF was there, EEM. I think this EWZ is a new one, Brazil Index, SLV was in there, XLE. I think these are the 3 new ETFs that were added. I know the oil was there before. I know FAS and FAZ were. Silver was already in there, the 2 golds. IWM had to be there because the Russell was there as well. So I think those are our 3 new ones, UNG, EWZ, and XLE. All right. So there are some new weekly options. There are now 50 securities that offer weekly options on a regular basis. Fantastic. All right. Well, it's pretty fun. Just a quick way to use the search tool, and I'll probably, I don't know if we'll get it posted this weekend, but we'll have a quick write-up in the blog there about the securities that offer weekly options and the new ones that were released today. My apologies, let's be correct. The new securities that were released on Thursday. In weekly options, the new series are always released the Thursday before the Friday expiration, so you have time to make adjustments before you hit Friday expiration. And of course, there were no new options released last week, simply because everything naturally had an expiration this week. So this Thursday, the new series were released for the first week in March. So now a total of 50 securities, stocks, indexes, ETFs, and ETNs that offer weekly options. Okay, let's see. Who has any questions there? Still don't have any questions coming through. Nancy, I don't know if you, Nancy's online with us. Nancy, I didn't know if you saw this or not, but Silver Wheaton, after its decline down to 31, has come back up to 39.19. So those 39 long calls that I used as a adjustment from the ulterior or alternative adjustment to income method number 4 are looking a little bit better now. So I might consider closing those on Tuesday or Wednesday. I didn't close them today, but I might consider closing those March 39 calls I had on SLW sometime next week, Tuesday or Thursday of next week, to still retain some of that reasonable amount of profit on them. Didn't give up too much, actually, as it turned out. And yes, it would have been better had I not done that, but at the time I still had the expectation that the stock was going to continue to move up in price. Oh, I know what I wanted to show everyone very quickly. Hold on one second. Let me go back to the main home menu. I want to just go in the Learning Center very briefly, and I'm going to go into the Webinars section. So to access our archived webinars, just go from the main home tab to the Learning Center, and let's click on Webinars. And what I wanted to show here is we spent the first 20 minutes, 25 minutes or so with that impromptu discussion we had on the rolling discussion from positions that are too deep in the money, when is it an idea to roll, not to roll, and so forth. We did one previously. It's in the Options Strategies archive. It was a similar presentation on the conversation of waiting to roll, how you don't always just want to roll for the sake of rolling. How sometimes when you're coming up to an expiration, or in this case we're at February expiration, but we have a March option, we're holding a March option, you might just want to wait until this expiration cycle to look for roll, whether you're in the money or out of the money, simply because you want to wait for the new series to come available so you can see more views and more opportunities of what you might want to adjust, what you might want to look at there. So that's where that's archived, and I'm probably going to clip that first 10 or 15 minutes that we just did, or that first 20 minutes we did today, or I might even take that presentation and redo it again at a later date next week, just that 20 or 30 minutes there to go in that range. Okay, so that's where all of our archives are, and of course we have some the other archives available. For those of you that have been following the educational series, the Power Options for Radioactive Traders, Part 4, the hour and 40-minute discussion on using the portfolio tools was archived here. That was put up this morning, or this afternoon I should say, so you can access that at any time as well. And of course Part 1, Part 2, and Part 3. All right, fantastic. All right, looks like we've got a question coming in here. Let me get back to the main screen. I believe this is Chuk. Asks, can you comment on protecting against naked puts? Well, if I've got a naked put position open, let's just look at a basic profit and loss chart here. Over on the right, same parity position as a covered call position. My maximum risk is, of course, on the downside. I can't let the stock decline deeply on me, and then I'll be forced to buy shares of stock at the higher strike price. That's what the naked put obligates me to do. And so I might have a very large unrealized risk if I let the stock go 20, 30, or 40% against me. In reality, there's only two ways to protect, to me, and over my 8 years' experience, there's only two reliable ways to protect against that decline in a naked put. Let's take an actual example. Let's just go back into the search. I'm not going to use a weekly option. Yeah, I can. I'll use a weekly option. How about that? And the price line position is way too high. I'm going to just stick with the AIG position here. AIG is at 41.51. Sell maybe a February. Oh, I'm sorry. I said March. That would have been ridiculous. We still have 7 days left to February expiration. I'm a week ahead of myself, ladies and gentlemen. I apologize. But anyway, the next February cycle, we could receive $1 for that 41 put. It's slightly out of the money. Our expectation would be the stock would stay above 41. This put would expire worthless. We keep the dollar premium, or a 2.4% naked yield for a 7-day period. Before I would do this position, the first thing I would check, that looks like an expensive premium for 7 days. So I'm going to go into the More Information menu, and I'm going to go into the Research menu and Stock Research. The reason why I'm doing this is I wanted to see, yep, that's why. The next earnings coming up for AIG are in 2/24. So selling an at-the-money naked put with earnings coming up Thursday of next week might be considered a risky position. Let me rephrase that. I'll call it a risky position. You can call it whatever you want to. But I'm going to call that a risky position because it's going to be risk. But if I wanted to do this but protect some of this premium or some of this gain, what are my choices? Well, to me, the only two choices you have when you're selling a naked put that you want to have some guaranteed protection are either to turn it into a calendar spread, a diagonal calendar put spread, for example, or to potentially turn it into a bull put credit spread. What do I mean by that? Let's go ahead and take a look. I'm going to go to the profit and loss chart. There is our naked put position for AIG. Stock's at 41.51. We're going to sell a 41 weekly put for $1. And we're going to have some fun with this too. We're going to have some fun with this for next week, okay? All right, so we're going to sell a 41 strike put, the weekly option, for $1. Our goal, we want the stock to remain above $41 per share. If that happens, we'll make our 2.5% return. We are running the risk of earnings coming up at expiration. Let's follow this, shall we? Here's what I'm going to do. I'm going to create a new portfolio. I'm going to place this trade in it. So I'm going to click Add to Portfolio. And we're going to create a new portfolio here. So I'll just go ahead and I'm going to put in naked put discussion 2/18. Thank you. Just completely forgot today's date. 2/18. All right. Let me click Insert, and I'll have my entry field for a naked put position. I'm going to sell 141 strike put. I'm just going to use one contract for $1 price. I'm going to assume 0 commission. Okay. Let's go ahead and submit that. All right, so we have basic short put or naked put position into the new portfolio we created. I want to make the cash on hand a little bit more reasonable. Instead of $100,000, let's go ahead and change it to, think about this for a moment. Yeah, let's change it to $10,000. So I'm going to click on Starting Basis. And this takes me to my values for all of my portfolios. Now we did collect $100, but I'm still going to change my, no, sorry about that. Cash on hand to $10,100 because I haven't taken cash out yet. I do have a margin requirement, but I haven't taken cash out yet. We're going to put our starting basis at $10,000 as well. This is just so we can see the numbers a little bit more easily. And then we'll go ahead and hit Submit Changes. All right, let's go back to our profit and loss portfolio. All right, so I entered in this naked put. Now let's go back to our custom spread tool to continue our discussion here and also to add in a couple other positions. Now, can I use a stop order? Yes, I can. A lot of brokers will allow you to do that. So I sold my 41 strike put. General rule of thumb, whenever I do a credit spread, Choke, whenever I do a credit spread or I have a short option in this fashion or a naked put, what I'll typically do is look to buy to close the short put or the short option if we reach within 1 or 1.5% of my short put strike price. Okay, so just basic math there. Let's go ahead and do that. 41 strike. We'll do 1.5%. So that's about 62 cents. 1.5% of 41 is 62 cents roughly. So I'm going to look to buy to close my short put if the stock reaches or drops down to about 40. No, I'm sorry, that's not right. I did that wrong. I did the math wrong there. Yeah, that's about right. Okay. All right, so that's not good enough because I'm using too. That's why I'm using too close of an at-the-money put. Well, let's just use a strike price. I look to close it if it reaches the strike price. I don't want to let it get in the money. Okay, so that would be a stop loss. I could set a stop order with my broker to buy to close the February 41 put if the stock reached $41. You could also use a range or percentage of your premium. If we collected $1 premium for selling this short put, I could put in a stop to say, well, if the put price moves up 50% or 100%, if it goes to $1.50 or if it goes to $2, maybe I'll look to buy to close the call then, or I'll have my broker execute that. Now, why that's really risky is that come earnings, if the earnings for AIG are terrible or they disappoint and the stock drops down to $37 or $36 per share in the pre or post market, doesn't matter what my stop was, that gets violated and I get the stock put to me or my broker goes to buy the call back or buy the put back for 5 points. Let's say it was at 36. It cost me at least 5 points to buy to close our 41 put. So I collected $1 premium, but I lost $5 if I bought it back for the 6 points there. Or the 5 points there, I would have lost $4. So that's not appealing. The stop orders are not guaranteed exits. All right, so I wanted to change this maybe. Let's do a bull put credit spread. In a bull put credit spread, I'm going to keep the same expiration. We sold the out-of-the-money put for $1, 41 strike. I'll go to View Options here. Let me pull up my weekly series. And let's just do we could do a 2 or a 3 point spread. Let's just do the 3 point spread for now. So I'll purchase the 38 put for about 24 cents. It'll be nice. Let's take the midpoint. Natural bid's 20, ask is 24, so let's assume we buy that put for 22. All right, let's just take a look how that would look at the profit and loss chart. Okay, so now I'm only collecting 78 cents. But we have a floor here. The graph doesn't illustrate it as perfectly as I would like, but we have a floor here. So now, down at the bottom, we can't lose more than that amount. If the stock drops to $35 to $30 per share, probably wouldn't in a week, but if it did, we can't lose more than the difference in strike prices, our 3 points, minus our net credit. So we're only risking $222 with the opportunity to make $78 or 35.1% return. And we don't know what's coming up at expiration, so changing it to a bull put credit spread, especially in this scenario when we have earnings coming up, this is one guaranteed way to protect the downside. To protect a naked put position is to have it as a bull put credit spread instead of as a naked put. Now, the reason why I like doing this, or I like discussing this, is not only because we're discussing different strategies and options give us options, but why am I selling a naked put to begin with? First off, I should only sell a naked put if I wouldn't mind owning the stock. If I didn't mind owning the stock in my personal account, that would be the only time I would sell a naked put. I'm never sell a naked put just because of enriched premium or just because it looks good or just because it's a weekly option. A lot of the problems I've had with doing a consistent strategy where these new weekly options are available is, honestly, I don't like a lot of the stocks that are there. Some of them are too high priced and some of them don't have enough volatility to give any real decent premium on the weekly options. Yeah, the annualized return is better than the static monthly return, but we were only talking about 40 securities. And a lot of them are those ETFs that I wouldn't even touch because they're so low liquidity, or FAS or FAZ, so much volatility even in a 7-day time period, it's rough doing a directional position. As you can tell, I'm more conservative and I'm not that aggressive, when sometimes I probably should be with my trading, but that's the key. Is we want to focus on limiting risks, and if you're doing naked puts here and you turn it into a bull put credit spread, yeah, you're not making the full dollar premium you would have if you just sold the naked put, but you're still making a possibility of 78 cents. So let's say the earnings have no effect, or in a standard expiration cycle, AIG doesn't do as we expect and it drops down to maybe, let's say 40, our break even here is 40.22. Let's say it drops down to $40 or maybe even $39.50 in this area. Well, that might be okay. Sure, I'm forced to buy shares of stock at 41 still, but I only sold this put because I wanted to potentially own the stock. I didn't mind if I ended up owning the stock. But we keep this, excuse me, we keep our 78-cent premium, so our cost basis is really only 40.22. So if the stock was trading at, let's say, 39.75, we're only down 50 cents from our cost basis. What can I do now? Hey, why not sell a March 40 call? Or another weekly 40 call against it, turn the position into a covered call trade. But did I really, okay, so if I would have sold it for $1, if the stock was trading at 30.75 and we had the 41 put, well, our cost basis would have been 40. So we're still only losing 25. We're down 25 cents instead of 50. It's still okay. What I'm protecting against is the extreme unexpected if the stock goes down to 35 or 36. If I have a naked put, that's a 6 or 7 point loss from the 41 strike. Or 5 or 6 point loss from the 41 strike if the stock's at 35 or 36. With a bull put credit spread, I'm guaranteed that I can't lose more than 222. Now, that's still tough. We've all heard this, my discussion on credit spreads, I'm sure. You've all heard me talk about the credit spread positions and the lie of leverage. But what am I doing here? I'm essentially risking, I have a 4-to-1 risk-reward ratio. I'm looking to make 78 cents, and I'm risking 222. So I'm about a 4-to-1 risk-reward ratio, meaning that if I hit this maximum loss, I'm going to wipe out four previous trades with the same similar setup. Okay, so that might not be the best way to go for a consistent growth position. Okay, the market's been good recently, Chuck. Don't get me wrong. Naked puts and covered calls have been working very well for investors for the past, 5-6 months. Been a good bull market, but the gains are capped too. It might have been better off just being in certain longer stock positions. Now, what do I refer to? This is one way, the bull put credit spread. Let me not get ahead of myself. Let's go ahead and add to portfolio here. Did that not click over? Whoop. There we go. All right, and we're going to put this in naked put discussions 218. Go ahead and click insert. So we're going to sell the 41 strike put, the weekly, for $1, buy the February 38 put for 22 cents. So net credit still of 78 cents, treating as a paper trade, no commissions. Let's go ahead and click submit. All right, so we've got a short put and a bull put credit spread now, protected, guaranteed by this put price. Now let's go back to our custom spread menu again. One last quick thing. What are we going to do? We talked about a diagonal spread. Now we're using a weekly option, so I'm not going to create a true long-term diagonal spread. I'm going to use a shorter term because we'd assume rolling it with weekly options. Now, when doing a typical diagonal spread, it's a bearish approach, meaning that I'm going to buy an in-the-money, far out in time put. So on AIG, right now with the stock at 41.51, what I might do is go far out, maybe 5 or 6 months, buy an in-the-money 45 strike put. Then at the same time, I'm going to sell the 41 put. Now my goal here would be different. When doing that type of diagonal calendar put spread, what I'm considering is not trying to protect the naked put. I'm actually doing a bearish play. Let's show you an example of that. So I'll go back into the View Options menu. What's at least, August, 183 days out, 6 months out. It's a good starting point. We could go to the full leaps there, but we're going to start with the August one. And I said we do have single strikes, but I said 45 put, so let me go ahead and add that in there, and right now the cost is $7.50. Okay, so I'm going to buy an August 45 put for $7.50. All right, well the bid ask is kind of wide, so let's just call it $7. Let's keep the numbers even. And let's go ahead and click on Submit. Okay, so now this is a bearish position. Now the maximum profit is going to occur for me if the stock's trading right at $41 at the end of this weekly expiration. My total investment and total maximum risk is $600. That's if the stock went up in price. If the stock if it gapped up severely and went to $60 or $70, my long put would expire worthless. The short put would expire, but my long put would expire worthless too, and I've got a $600 debit or $6 debit here. I'm expecting in this case the stock to move down, and this isn't really your goal here because we were talking originally about a naked put, which is neutral to bullish. By doing this diagonal spread, we're creating a bearish position, a standard diagonal spread where we buy the in-the-money call and sell an at or out-of-the-money near-term call, but still has a 21.8%. Well, let's reverse this in the sense of we're going to keep a neutral to bullish concept, but we want to have some protection but go further out in time. So we're going to still sell our 41 strike weekly put for $1, but instead of buying the in-the-money August 45, which would create a bearish position, overall bearish position, long term, let's go back to August, and that was 4 points in the money from where the stock is now roughly. So let's go 4 points out of the money, and the stock's at 41, so let's use the 37 put. Well, you know what? Let's use the 38 because we used that in the bull put credit spread. Let's keep it fair. Let's use the 38 August put far out in time for a premium of, big gap there, 262 to 340. Let's call it $3 and make it even numbers, all right? Okay. So I'm going to add that there, and we're going to put in an ask price of $3. Whoops, apologies. All right, let's go ahead and click Submit. All right, so this is what happens when we do these types of diagonal spread. Yes, this is more of a bullish to neutral position now, but in reality, we don't want it to go too bullish. We want the stock to be right in this range in the next 7 days. That's really what we're looking for. And with earnings coming up, it's going to be tough to do, isn't it? So, all right. Now, this does have an upper and lower break even, as you can see. It's a little bit higher up here on the upside for the weekly expiration. But let's go ahead and do this one as well. And this is definitely more of a longer-term play. As we saw with the naked put, we'd expect in the next 7 days that the stock stays above 41, the put expires worthless, we'd keep our full premium. The bull, we could put stop orders into our position, but if there's a gap, which there will be some kind of gap potentially, I shouldn't say there will be, there potentially will be a gap because we're doing this with the knowledge that earnings is coming up on the 24th. And what we're also doing here now, with the bull put, that gives us a guaranteed floor if the stock tanks on us after that event. And with this calendar put spread, we're doing that too. But this might actually work in more of a beneficial fashion because we have such a long term for that August put option that it's not just a one and done trade. See, with the bull put credit spread, if the stock tanks down to $37 or $36, $35 on the 24th when earnings come out, well, you only have about half a day left for expiration on your long put and your short put. In this scenario, if the stock drops to $35 or $36 on Thursday after the earnings event, your 41 put will expire worthless, but you still have 100 and some odd days remaining on this longer term out of the money put option. You could manipulate that after that happens. Well, let's add it in there. Add to portfolio. Okay, and naked put discussion 218. Let's click insert. All right, so there's my 41 put, August 38 put. Just do one contract, keeping the numbers simple. $1 for the premium, $3 for the ask. Those between the bid ask, and let's go ahead and click submit now. No commissions, of course. All right, so we've got a bull put credit spread, form of a calendar put spread, and a short put. All right, what are we going to do? Well, one thing I was going to do, I'd mentioned that we would put in a stop, let's say if the stock was trading at $41. So for the short put, I'm just going to put that in. I'm going to go into my alerts and click on view. I'll leave the option change of 80, but I'm going to put a stock price limit. My lower stock price limit is 41. So if the stock drops to 41 and is right at the money, that might be an alert for me to look to roll the call, or roll the short put, my apologies. Now we know when earnings are, but I'm just going to put in the earnings date check as well. Let's go ahead and put in 1 day so I know it's coming up. All right, great. Now I'll click save, and these alerts are set. Now nothing's triggered yet, but you see that I did add a lower stop column in there onto this position. So we have our 3 entries in there. I might do a write-up a little bit later this week, and we'll go ahead. I'm sorry, beginning of next week or this weekend, I'll do a little write-up. We'll put that in the blog as well as to why we just entered these 3 positions. And then what we'll do is next week in the open discussion presentation, we'll review how each of these 3 positions worked out. Now, what are we expecting is going to happen? Well, if the earnings are good on the 24th, and please, 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 I hope everyone understands this is definitely not an expiration. I'm sorry, this is definitely not a recommendation or suggestion. I never enter a new naked put if I know that earnings are coming up between now and the expiration date. I'll look at that at a different time. Oh, Nancy, I'm not doing any. No, Nancy, I'm sorry. We're not doing any analysis on this whatsoever. We just grabbed the first naked put we saw in our weekly search, and we're doing this because we know earnings are coming up. So what I'm doing this for an example for Truk for, which we'll review next week, is let's just say you took any position and you entered the naked put here. We're not basing it on any kind of research and analysis, Nancy. This is just to show the 3 strategies. Okay, that's what we're going to review next week. What happened to the 41 put? What happened to the bull put credit spread? And what happened to the calendar put spread, with the knowledge that earnings are coming up and something's going to happen. Now, what are our expectations going to be? If the earnings are good or AIG is strong, well, the stock's probably going to be above 41. What's going to give us the most profit? Well, the most monetary profit is actually the most monetary profit would come in with the calendar put spread in that situation. Well, if the stock's trading right at 41, it'd be $111. For the naked put, it would be $100. And for the bull put credit spread, it would be $78. Okay? Now, the return, leverage return, works for us and works against us. The naked put return is lower at 2.4% because if I entered this 41 put, this naked put against AIG, normally I'm 100%, I have to put up 100% of the margin requirement, so I'd have $4,100 on hold in my account. So I'm looking to make $100 against $4,100 to cover the case that I do have to purchase the stock. So that would be my 2.4% return. Remember, with the credit spread, you've got a 3-point difference between the strike prices. So the most I'd have to put up is the 3-point difference between 41 and 38 because I'm capped at my loss. So we're looking to make 78 cents versus a risk of $3, so that's why it's a 35% return. And our debit, actually on the calendar spread was lower. We were going to pay $3 for the 38 put, and we sold the 41 strike put, So all we'd have to put up is the debit of 2 points. So if we make $111 at that point, that's assuming using the Black-Scholes pricing model to estimate what our long put would be worth if the stock was trading right at $41 on Friday's expiration. That'd be a 55.4% return. But we're going to see how this turned out next week on the open discussion presentation. We're going to see if the lie of leverage worked for us, if it worked against us, and if there was a gap. Remember, if it was a pre-market or after-market gap, this stop I put in at 41 isn't going to protect us. It's going to get violated, and then we'll get closed at the worst possible price. And I'll look that up that day to see what it is, and we'll review the results on next Friday. And we'll also probably share that in a blog article as well. And to really answer your question, Nancy, yes, of course. Before I entered any trade, you've seen my processes of what I do in the various webinars on the research and analysis for the married puts or for any other strategy. The same process I use in any other strategy. When I go into a search, for example, let's go back to the naked put search. When I first pull up my results, the first thing I always do is take a look at the stock chart. Does it match my trend and my direction, my expectations and goals for the strategy? I'll look at the company information, the news, the earnings events, and a profile. I already said in my personal research I would have negated the AIG position even though it has one of the best returns because earnings are coming up between now and next Friday's expiration on the 24th. And I also, of course, would have looked at the profit and loss chart to run some of my what-if scenarios, look deeper into that stock research and option research tool to see more data on both the option and the stock. And I might have compared it to other strikes as well. What is the 40 strike offering? Does that still match my naked yield goals for a weekly option, or maybe even the 39 strike? Well, for this example, we're just going to do some strategy discussion and see, okay, how would a naked put pan out, and how would a bull put credit spread pan out, and how would that calendar spread pan out? And of course, we know that if the stock stays the same or moves up in price or gaps up because of that, really the naked put and the bull put credit spread are going to work best. Oh, Margaret wanted to know, when would you close the bull put credit spread on the long position if the stock stays up? Well, essentially, I would want to hold it to expiration, which is only 7 days away, to get the full profit, and that full 78-cent profit on the position if the stock remains above 41. Other than that, I'd have my stop orders in place, and if those were triggered, I'd look to manage or close the position. And then, of course, just as we discussed before, when we were looking at that covered call discussion at the beginning of the presentation, I typically do follow the 80-20 rule, meaning if I have a covered call or if I had a naked put or even a bull put credit spread, if the stock stayed up and my time premium decayed enough to where I could close the position before expiration and realize 80, 85, or 90% of what I expected to make, I'll probably close it then. That 80-20 rule, take 80% off the table and then maybe look for a new position. Might be a little bit more conservative than some of you would like to do, but those are kind of my general rules. But really, looking at it in a different way, Margaret, really with the weekly option, I try to hold it as long as I could, especially through expiration if it's still trading above. And the reason why is normally, percentage-wise, right now, this is what we expect on a weekly naked yield in some of these positions. I have to research them further to kind of see if these are higher because the earnings event's coming up. But really about 1.1 to 1.5, maybe 0.8 to 1.5 is really about the range I expect to see for weekly option positions, the percentage yield. Now, some of these we're talking about 55 cents, 82 cents. Here's one at 22 cents because Microsoft's only trading at 27.06. Now, for the weekly options that, as a rule, will have lower premium because we have lower time, we only have 7 days of time premium that we're collecting for the out-of-the-money naked put. If I can hold it to expiration and still have it expire and realize the full profit, I really want to do that because if I start paying extra commission fees to buy to close the weekly options, that's going to cut into my profit. That's going to be much more recognizable as cutting into my profit as it would be for a standard 30-day or 45 8-out option. So for monthly options, hold as long as possible. Well, Margaret, yeah. But there are 3 basic scenarios for bull put credit spreads or naked puts. And the 3 scenarios when you open the position is, number 1, the stock hits your stop loss. You always have that in mind before you enter a position. Have a way to close the position. Even with a bull put credit spread, you want to kind of mitigate the loss if the stock really goes against you. You never want to take the full loss if you can avoid it. So you have your stops in place. If those are triggered, you'd close or manage the position. If the stock is stagnating, that'll still work for you. See some decay, but even with a standard option, the month-by-month options, Margaret, you won't see a lot of opportunity to close early for that 80% gain unless you're within the last week. Even if the stock's just, for example, in this AIG, if we did the March, February 41, and the February 38, if the stock stayed right at 41.51 for the next 2 weeks, I still would only probably be able to liquidate the whole spread for maybe a 40 or 35% gain. I wouldn't be close to that 80% gain just from time value decay over a 2-week period. So it's usually better to hold them as long as possible. But one of my other general rules of thumb there, Margaret, of course, yeah, what we're really looking for is what if the stock spikes on the 24th? If we're lucky enough to have the stock spike on the 24th because we entered this position where we shouldn't have with earnings coming up between now and expiration. Well, if that spikes up and let's say the stock goes to 47 or 48, most likely then we could probably close our short put or the bull put credit spread for near to that 80 or 85% profit once it gets very deep out of the money and the options just start going to zero. But it's usually the common scenario is you end up holding it for as close to expiration as you can to let the time decay go out of it if you haven't been triggered with a stop loss yet. Oh yeah, my other basic general rule of thumb, which has nothing to do with market conditions, timing, or anything like that. If I'm tracking a trade, let's say I did have the March, February 41, February 38 bull put credit spread open, and 2 weeks from now I'm looking at the position, I say, I wonder if I should close the position. Usually when I say that to myself, for whatever reason, whether I don't like the current market conditions or something happened with another stock in this sector or industry, or I'm just not happy with the way the market's going, if I ever find myself saying, I wonder if I should close this position, I usually just end up closing the position. Whether it's a good idea or a bad idea, whether hindsight 2020, it worked out for me, it didn't work out for me. The minute I have any doubts about a position that I'm in, I'll usually close it even if it's for a loss because for whatever reason, I'm not comfortable with that position. I don't want to be dreading over it. That's silly, psychological, philosophical approach. It's probably not advisable to follow that general rule of thumb, but I tell customers just to be honest. Look, and whenever I'm tracking a position or I'm looking at a position, I say, yeah, no, I don't know if this is working out the way I wanted it to. I wonder if I should close the position. The minute I have that thought creep into my head, I'm usually probably closing the position within the next hour or two. All right. Well, ladies and gentlemen, I'm going to wrap up and navigate back over to the last few of the slides there. If you have any other questions, go ahead and send them over. We did go 15 minutes over to handle all the questions, but I think it was well worth it. Just want to remind you, of course, the 20-minute delayed service to PowerOptions gives you access to all the tools on the tool menu with 20-minute delayed quotes. That's $59.95 per month or $600 for the year. The real-time service gives you access to all the tools on the tool menu with real-time quotes instead of 20-minute delayed, and that's $79.90 per month or the discounted rate of $800 for the year. The historical tools that we kind of looked up today a little bit, that's not included in the 20-minute delay or the real-time service. You can access a 3-month subscription for the historical tools for $99.95. But if you're already on the real-time service, it's actually cheaper just to upgrade to the professional level of service. If you run the real-time service, you want to look at the historical tools. The professional level of service includes everything that's on the real-time service plus the historical tools, and it's only $20 more a month at $99.99, whereas the 3-month access, or the 3-month subscription would cost essentially $33 per month. So it'd be cheaper just to go to the professional level of service if you wanted the real-time and access to the historical tools. Oh, I didn't change this part of the slide, but it's still kind of accurate. Just wanted to remind you of our upcoming free events every Tuesday and Thursday at 12 noon. Kurt Frankenberg, that's 12 noon Eastern Time. Kurt Frankenberg hosts these Introduction to Radioactive Trading presentations. This Wednesday at 9 p.m. Eastern, which actually might become 8:30 p.m. Eastern Time, we're going to wrap up our educational series on using the PowerOptions tools for radioactive traders. This would actually be part 5 coming up on Wednesday the 23rd at, there we go, part 5, at 9 or 8:30 p.m. Eastern Time. I haven't decided if we're going to make it a 2-hour or run an hour and a half. But it's going to be the open discussion. Part 5 is the open discussion, so any last questions that you have on using the PowerOptions tools for radioactive trading, that will be that presentation next Wednesday night at 9 p.m. Eastern. Typically every Wednesday at 12 p.m. Eastern Time, we hosted just a basic introduction to PowerOptions presentation, and next Friday at 4:30 we'll have another open discussion series where we'll talk about our 3 positions, the naked put, the bull put credit spread, and that calendar put on AIG, with the knowledge that earnings are coming up between now and the weekly expiration cycle. All right, well, if you think of any questions after the presentation or any time next week, please feel free to send us an email to support@powerop.com, or you can also call us toll-free during market hours. If you live inside the continental U.S., you can reach us at 877-992-7971, or if you live outside the continental U.S., you can reach us at 302-992-7971. There are also contact links on every PowerOptions page. Now, I can't guarantee, so I'll just say it, most likely someone's going to be in the office on Monday. Remember, Monday is a holiday. The markets are closed, so we have to look to open our new positions on Tuesday. It'll be Tuesday the 22nd there. So someone may be in the office at a given time. Ernie might come in the morning. I'll probably be here at some point in the afternoon, but I'm not going to guarantee that anyone's going to be here on Monday. So if you want to reach us by phone, best time would be probably Tuesday afternoon, or I'm sorry, Tuesday during market hours is when we'll be back in the office. But you can send us an email at any time. Usually check that over the weekend. So does Greg, and so does Ernie. All right, ladies and gentlemen, hope you had a great, fantastic expiration. I hope you enjoyed the webinar presentation today. We'll cover those 3 spreads next week during the open discussion presentation. So if you want to see how those performed, and I'll also write a couple blog articles about those as well, just some discussion on what we talked about today, and of course the 3 positions we entered and why we discussed entering them, and I'll also at the end of next week talk about how those 3 performed. Well, I hope, again, have a great weekend. I hope you enjoyed the presentation. I hope you all got some useful information out of this, and I hope you all had a great expiration. We'll see you next week for those free webinar presentations, and I'll let you all know about the different write-ups that come up for what we talked about today. Take care, everyone. Good night.